Hello, everybody, and welcome to this week's edition of the Dorsey Wright podcast. My name is Miles. I'm joined by good friend and colleague here, Joseph. Joseph, how you doing, my friend?
Good. The weather's starting to be consistently warm.
I know we were walking outside yesterday. We're just like, I don't think I want to go back to work.
Well, I'm like wearing like a pullover or whatever because it's 50 in the morning, but once you walk outside for like walking to lunch or something, or
Yeah,
it's like, 72, feels great, a
yeah,
nice breeze.
yeah. Well, here we are talking about the weather. You did something much more exciting than talk about the weather. How were the Eagles? You were out in Nashville,
I did see the Eagles. So I like classic rock. The Eagles are great. They're my wife's favorite band too.
right?
So we were out in Nashville. We got to see them live. They were there for one night. It was awesome.
Yeah, I
So that's
imagine.
something that our listeners might enjoy. The people that have been around a while are probably still big fans of the
Yeah,
the Eagles.
yeah.
So
Well, I mean, who's not, right?
yeah,
So, but
I mean,
yeah,
I'm not the biggest Hotel California guy. Like, it's great song, but it's a
you can appreciate
little
it.
overplayed. You can
Yeah,
still appreciate it. I'm glad they knocked that one out first, though.
right.
I think they probably wanted to get it over with too.
Right.
But yeah, it was a great time.
Well, and speaking of Nashville, we have to do a shameless plug. We are coming up on our annual event over in Nashville, Tennessee. It's a great time, whether you are a Dorsey Wright veteran who's been around for years and years and years, or whether you're just getting used to, Dorsey Wright, point and figure, momentum investing, trying to figure out where it fits within your practice. That is coming up at the end of September. Is it end of
Yes.
September?
Yeah. End of September. We also have early bird pricing that ends at the end of June. So if you want that, you know, discounted pricing, make sure you sign up ASAP.
Yep. And, if you, it's one, it's on the platform, but two, if you can't find it, shoot us an email, give us a call. The contact information is down in the description below. So all that said, though, shameless plug aside, good week for markets. It feels like you and I get on every single week and are just like, yeah, man, markets moved up. Nasdaq composite up over 3%, gold up nearly 3%, the S&P 500 up nearly 2%. This is over the last week. The only real names landing in negative territory, fixed income, the US dollar. Besides that, pretty much everything green.
Yeah. It's, I've oil has kind of caught a little bit. And the markets have really just shaken it off. Especially on the, uh, emerging developed markets outside ex-US have held up relatively well too.
Right.
It's really interesting environment, especially the last like 2 weeks. You get the rally off that March low, and it's really just like continued to full throttle higher.
Well, and you and I weren't planning to talk about this, so maybe we'll keep this short. But I'm curious on your thoughts because back when we were thinking about the 2026 lows, it was pretty much an inverse relationship between crude and domestic equity markets, right? Because further unrest in the Middle East sends crude higher, sends equities lower, but that doesn't necessarily seem to be the case right now. Like I'm just curious on
I think the
your thought.
volatility's cooled off in crude quite a bit,
Right.
right? I mean, it's still bouncing around a lot, but it's seems like the market's not as worried about $200+
Right.
barrel oil now, which gives at least a level of some certainty to the market,
Right.
right?
Gotcha.
So I think they're a bit more confident putting money back to work. And then obviously, once you start really rallying like this, people are going to be chasing if they were defensive for too long,
Right.
right? Um, so yeah, I think that's one of the reasons oil hasn't had that big of an impact, even though it's still about $100 a barrel. Now it's going to depend on how long this goes on too, right? We had some pretty hot inflation data
Right.
this morning, um, but it hasn't bothered markets. It seems like today.
Yep.
Right now we're up, but we'll see. We'll see what happens. I think generally speaking, there are two scenarios where this thing gets drawn out for a while and crude kind of sits around this low 100s area, or there's some sort of resolution.
Right.
And I think the bottom kind of falls out for crude if
Right. And
if
then
that
it's just all
happens.
bets are off, and who knows? We're
Yeah, who
celebrating
knows
Dow
where we're going? It
60,000.
could be one of those buy the rumor, sell the news type of deals.
Right.
Who knows?
But as we talk about one crude, first off, I appreciate your insights on that. Second off, though, we are sitting here, and now, just a few months ago, we were talking about markets being beaten down, oversold. Now we're sitting here just a few months later talking about markets being particularly overbought, mostly due to one sector, which we'll talk about a little bit later. But Markets are a bit overbought, and we put together, if quite frequently people call in and ask us, well, Dorsey, right? Are overbought markets bad, right? And the first thing I think we need to do is talk about what we mean by overbought and how we quantify that. And then the second thing is perhaps talk about, you know, is that actually bad, right? Like, and most of the time, right, as I pull up some research that we had done on the overbought markets front, most of the time it's not that bad. But why don't we talk about what it means for an asset to be overbought, how we quantify that specifically for the core,
Mm.
and then we can talk about the returns.
Yeah. So on the asset class group scores page, we have the S&P 500 index funds group, which just looks at it's comprised of um, a bunch of S&P 500 index funds, essentially,
Right.
and we take the average score of those, and that's its own group. And then we also keep track of the overbought oversold readings for um,
Those funds.
those
Yep.
funds. Uh, Now we hit over 100%. Usually, we consider above 70% heavily overbought. I would say over 100% is really where you're like, okay, things are really frothy at this point, especially when you're talking about the broad market, right? Sometimes you see individual stocks get to like 250% overbought, but
Right.
it's because of earnings or something like that. Um, it happens. Honestly, usually if you're overbought, it's because price moved higher and you're
Right.
in a strong sort of market environment, right? Um, I guess the more of the question is like, well, how do we do over the next couple of months,
Right.
weeks, things like that? And as we see in that table, 1 month returns on average up 62 basis points, which in the grand scheme of things is pretty good.
Right.
It's not like it's bad. Median's even better at 1.1%. Um,
And percent positive 75% of the time. So three-fourths of the time you're positive a month later,
yeah,
right? Then you kind of just get up maybe 3 and 6 in 1 year. 1 year they're a little bit, difficult to associate with any one particular overbought
yeah,
stance. The point here is though, is that shorter term time frame, even 1 week later, 2 weeks later, over 50% of the time you're positive, right? And this is just kind of some evidence to say, hey, markets typically do quite well, right? Markets typically go up. And it also lends to this idea that we talk about quite frequently, which is you can normalize in two ways. The first is the one that everyone's familiar with, which is price falling back down. The second is just sticking around for a while,
yeah,
up in those elevated levels. Those overbought, oversold readings that we're referencing, they're anchored to essentially the 50-day. And so, the closer you are to zero, you're closer to the 50-day. Now, again, that makes sense for individual names, less so for, a wider basket. I digress though. When those older, lower values fall off, that overbought, oversold reading will start to come down naturally. And so point is that you can stay up or stay elevated, and then see that value kind of come back to what we would call normal.
yeah. Plus, there's a volatility component to it, right?
Right.
So, like with markets a bit more volatile, even though the VIX has come down, but if you look at like just upside price volatility,
Right.
still a little elevated. Um, but yeah, the general thing is every time we look into this, no matter really how we slice it, it's usually pretty good that you're overbought.
Right.
Even though the returns may not be really. I think the thing is like the returns. You can't expect the returns to be as good as they were leading up to what made the market overbought,
Right.
right? Like I think it's hard to expect April. What happened to markets in April that also happened this month too, right? Um,
Well, because then you start getting into like pricing, like, well, like this is a nice segue into our next job. It's like, what are markets actually like priced, right? And we are not a fundamental driven shop, right?
mhm,
So most of it is going to be, what goes up will continue to go up, what goes down will continue to go down. I would probably say up to a certain extent, right?
yeah.
And so you had put together a pretty good piece about, kind of the was it trailing 12-month PE ratio for the market versus, what we're pricing in for the next 12 months,
Yeah.
right? And then the spread between those two items.
Yeah. So this was inspired by Chuck Fuller, one of our PMs, sending in something about SanDisk having a forward PE of only 8.
which is crazy.
Yet that stock is up over 500% this year.
Right.
But generally speaking, so we looked at the last 12 months for PE for the S&P over the last 12 months versus where it is for the next 12 months. And we looked at it historically going back to 1999. And usually you see next 12-month PE lower than last 12-month PE because the market's pricing in earnings.
Some type of growth. Right. Yeah.
Right. Now, what we looked at was, well, the absolute readings for each of those are pretty elevated historically.
Right.
Whether it's last 12 months or next 12 months for the S&P. Second, we looked at the spread between those two. So how much expectations are there on the market to grow its earnings, essentially to justify the what they're trading at, the price level they're trading at. So we just did the PE of the last 12 months minus the PE of the next 12 months, and that hits 7. There's only 3 times in our data set it's hit 7, was 99 and mid 2021. Obviously not the best markets moving forward,
Right.
but also a really limited data set, which I tried to mention like multiple times in this piece. Like, don't start selling everything just because this is going on. But what I do think it shows is that if the market does not live up to those earnings expectations, it could be a really rude awakening.
Right. Well, and 2021, right? You kind of get into maybe post-COVID, right?
A lot of fiscal monetary stuff going on. Kind of hard to draw any parallels there.
Now, I will say maybe 99 is a little bit easier to draw some comparisons.
But that's that's been done for the last 3 years, right?
Right, exactly. And now we're not, neither you or I is doing that. But it kind of gets into this. Well, yeah, expectations are great, but so is the potential, right, for these companies to grow those earnings at that rate, if they can properly utilize or incorporate AI, right? And so, that's the whole semiconductors thing, which we'll talk about in just a moment. But, it certainly is interesting to say the least, and a great article and great find from, us who doesn't talk about the fundamentals and price justifications as much. I wouldn't, like you said, very limited data set for you listeners. I wouldn't go, calling mom and telling her we got to get rid of everything. But it certainly is, interesting. And I think the most important part is that, hey, markets are expecting, this is going to sound so silly, markets are expecting greatness.
Yeah.
They're
expecting more than greatness right now. What I also think is interesting, the last 2 times that happened, we looked at like forward returns for the S&P.
Right.
And over the next 6 months, on average, they were up 8%. So both instances, they were up over 7% over the next 6 months.
Right.
So, you could sell now and be like, oh, we're 8% higher than we were. Although both markets ended up entering a bear market at some point over the next 2 years, if you use the 20% drawdown metric. But again, maybe AI, is that big of a deal to justify these kind of price levels. Who knows? I think what it is something to keep in mind if you start to see the results not look as good for some of these AI related names. They could have a long way to fall.
Honestly. Well, and the last point I'll make on this one, and then we gotta keep it moving. Nobody wants to listen to us talk for this long. But when you talk about the next 6 months, I think it brings up a really good point that we talk about frequently, which is markets can stay irrational for longer than you can stay solvent sometimes, right? And so, that's kind of, you would have said, hey, after this spread gets high, the other 2 times, well, if you're looking at this, you would have said, oh, it's gotta dissipate. It's gotta come back down, right? Well, it didn't for 6 months, and 6 months is a long time to be betting against the market, right? So keep that in mind. Moving on, though, we'll talk about 2 momentum pieces, or one piece and then one reading that we typically look at. The first, the article will be the third part of this momentum pitfalls piece that we as a team have been putting on the platform, answering 3 main questions. One, the first one you and I talked about a few weeks ago, that being momentum is streaky, in a previous podcast. The second one we didn't get to, but we'll skip, but it's on the platform if you want to read it, that being that momentum inefficiently chases winners. And the third one, which we'll talk about today, that being that momentum is tax inefficient, right? Because it's making a lot of trades, it's churning, you're realizing a bunch of short term gains as it's figuring out its winners and losers. So there's this idea that momentum is tax inefficient. And what we've done is we've created on the platform a tax efficiency score. As I share my screen and kind of bring up that here we are. We'll bring up this kind of tax efficiency score, particularly here. Now, what this does, and you can find this for custom models, pre-made models on the Dorsey Wright platform. What this does is it breaks down all of the trades for said model, and it looks and categorizes them into 4 different categories: short-term losses, short-term gains, long-term losses, long-term gains, right? Now, for taxes, we want as much of our gains as possible to be classified as long-term, right? Because they're taxed at a more favorable rate. All that to say, though, when you take a look at, for instance, the large cap core model, which is just the kind of a rotation-based model focusing on strength within the S&P 500.
Yeah.
When you take a look at all of the trades, historically speaking, without looking, Joseph, what percent of trades do you think are short-term losses?
Short-term losses. Say probably about half.
Probably about half, around 44%,
Yeah.
right? And so said otherwise, for those of you listening, it sounds like a death by a million cut scenario, right? Where you are, you're just constantly, losing. Around half of your trades, again, are short-term losses. But the most important part is where those gains are coming from. So only, right, sorry, 28% of your trades, right? 28% of your trades are long-term gains. But when you actually classify where all of the monetary gains are, so not just a number of trades, but where all the monetary gains are coming from, around 78% of your total realized gains, 76%, excuse me, 76% of your total gains realized are long term. So I'm kind of rambling here. The point is that most of your trades are short term losses, but most of your actual realized gains that you're realizing are long-term gains.
Yeah.
Does that make sense? Help me
Yeah.
say that
So
differently.
I would say at most, I would say a majority of your trades.
Yes. Yeah.
Right. But yes. And this is like a specific model, right? But this is the trend across most momentum type of strategies. And you mentioned like, oh, we're making a lot of short-term losing trades and it's death by 1,000 cuts. Well, it's really death by 1,000 cuts if you trim winners too soon.
Right.
Right.
Yeah.
Because if you miss those, the right tail distribution, some of those trades, I mean, that's where a huge amount of the returns come from over time. But also, it's really good for this, that it's on the site, like it's a tool on the site that people can use.
Right.
To talk with clients about, hey, I know we're worried about taxes and you're worried about, oh, we're going to be, using discretion here and like making trades and things like that. But our process is designed to mostly look at long-term gains,
Right. Cut your losers
or at
and then
least as a result of our process, most of the gains
yeah.
are long-term.
Exactly.
Right.
I appreciate that because I was just going to ramble on about it. But yeah, that is really the gist about it. It's, most people, because they see heightened trading activity, they see, oh, well, you got to be realizing short-term gains. It's got to be inefficient, right? Most of our stuff, that isn't the case. So we'll kind of wrap that conversation on that specific point. But all that to say, the broader piece that includes all 3 of those pitfalls and some of the frequently asked questions, that's going to be on the platform. So feel free to check that out and utilize it as you're kind of entering those client conversations. Continuing our conversation on momentum, though, talking about relative strength spread, right? It's been a pretty good year for momentum, right? As winners have kept winning, losers have kept losing. And to kind of measure how strong that is, the analyst team or Dorsey Wright utilizes what we call RS spread, which again measures the dispersion between a basket of winners and a basket of losers. So why don't you talk about that while I share my screen for a sec?
Yeah. So RS Pro is an index where just essentially the change in the percent change in the index each day is just the difference in performance between high momentum name versus low momentum name. So if this
Right.
is moving higher, high momentum names are doing really well. it's moving lower. Low momentum names are doing better than high momentum names. Over time, this trends higher, right? But recently, this thing has just shot higher, especially since I would say mid 2025. This thing has been on an absolute tear.
Right.
Just broadly speaking, momentum strategies have done really well. Another thing that's kind of overbought right now, I wouldn't look too much into that though. As we talked about earlier, usually it's a good things when things become overbought.
Right.
That's because they're doing well, right? Um, and it's interesting too because you put a piece in just big names, big returns, talking about how the S&P cap weight had been just demolishing the equal weight on this run back up. And it's interesting that RS spread um, did really well when we were kind of like in a equal weight period briefly where it did really well, and then the cap weight period also it's been holding up really really well.
Right.
There's a lot of dispersion in the market essentially to take advantage of.
Yeah, like industrials are a really good sign of that. Industrials, like are a sector that's been hanging around for quite a while,
Yeah,
right? And they've done quite well from a momentum perspective. Technology obviously has this is as we move over into semiconductors.
yeah,
But semiconductors have been really strong. Meanwhile, software has been really weak. So yeah, it's been a I'll actually give you that. It's been a really surprising instance where we saw momentum hold up quite well to start the year through the decline, and now we've turned. You might think that momentum would be kind of behind the eight ball, right?
hmm
Because we're chase winners essentially, but it actually hasn't turned out to be the case. So yeah, momentum continues to do well. Spreads like this look really productive also on the international front,
yeah.
right? Within developed and international markets, or excuse me, developed and emerging markets as well. So pretty much across the board. And don't take our word for it. We're not just talking it up.
Mhm.
But across the board, momentum's been in a pretty productive environment, which is always good for trend followers.
It's really good, and it's a very interesting leadership. I would say it's like a diverse leadership in terms of like there's a ton of leaders, right? But it's not the Mag 7 obviously is doing really, really well, broadly speaking. But it's some of these smaller companies that are also doing really well. Um, like Seagate.
Right.
Those type of names are just going, bananas to the upside.
Right.
Um, so it's just a really interesting environment. There's like some diversity in terms of size, um, but it's also like the Mag 7 stuff is still doing exceptionally well.
Right. Well, speaking about Mag 7, we'll wrap up with our last chart of the day and take a look ahead of earnings. We won't be able to talk about it next week without it kind of getting in before earnings. So we figured that we would talk about Nvidia this afternoon here. Obviously, semiconductors, as we've talked about how strong they've been for what seems like the last 2 months worth of podcasts here. Semiconductors have done quite well, really without Nvidia for
Kind
the
of.
most part. Now NVIDIA's picked up, right? So
Yeah.
it's like, now NVIDIA's there, but we've seen NVIDIA just move to the new all-time highs on the chart today.
Yeah, and it's interesting because you're like, "Oh, NVIDIA, I mean, it's a 3 for 5er, but it's up 18% this year." But really the only reason it's a 3 for 5er is because
Can't keep
versus
up
its
with
peer group,
right.
semis,
Yeah.
it can't keep up.
Yeah, look at that.
It's
On this
60.
63rd out of 68 within that semiconductor matrix. So
Yeah,
there's a lot of better stocks within the semiconductor space. And like you said, it's up 20% this year. So
yeah, yeah. So, interesting, like, a new all-time high today. Another thing that's heavily overbought. But, we'll see how earnings shake out. That'll obviously set the tone for the next, you know, big move in semiconductors. Um, Also, we have, you know, I didn't even really realize this until the other day, but NVIDIA CEO is with Trump
right,
and at the China
right.
summit too.
Yeah,
So you could get some news come out of there as well. Maybe there's like some deal made where NVIDIA is allowed to export a bit more chips to China and things
right,
like that, which could be a really big catalyst to the upside, or things don't go well
right.
and
Yeah,
they're like, okay,
yeah,
yeah. So going to be a news heavy week for for Nvidia and I think semiconductors broadly speaking.
Right, certainly. And, you know, it just from a purely technical perspective, you know, you see that support offered. We had talked about, hey, we've really just been consolidating for the better part of the last year or so, kind of really between, you know, the mid to upper 160s to, you know, the mid 190s or so. We had then broken out past that level. We talked about, all right, well, you know, we need to pull back here. Then we ultimately pulled back and now have some support offered at the top of that old range. So from a technical perspective, you've got a nice little setup here where we've got support, we've got a base to work off of above the top of that previous range. Old resistance acting as new support is always a good thing.
Yeah, I mean, that breakout of the range, kind of retest of the big resistance area around 195 and then immediately push into all-time highs is it's just really strong move
Right.
for Nvidia.
But like you said, I mean, you know, we aren't naive here. There certainly could be a lot of headlines. The point of Point and Figure is to help us look through some of those headlines. So we'll only show price action if it's significant enough to kind of filter through. Otherwise, we'll just kind of let it be and move on to the next chart, I
Yeah,
suppose. I'll let you have the last word. Anything?
I don't have anything.
Okay.
If you can go see the Eagles in concert, go do it. They still got it. Even though they're like in their mid to late 70s, they still got it.
Still shredding.
Yeah,
But
Joe Walsh is still shredding.
yeah,
Yeah.
good to hear. All right. Well, listen, y'all, we appreciate the time. I hope everyone has a wonderful and safe week. And we will be back again next time to touch on any other updates. Bye bye.